I'd like to welcome everyone to our 2025 mid-year review. And I have Chris Cannon on one side of me, Greg Trasky on the other. I got bodyguards, these people. 6'4", I'm protected right here. I'm insulated, I'm diversified. These guys are big, they're strong, they're young, and they're smart. That's why I really like them, because they're smart. But while we have people filtering in now, so we just take a minute and say hello. And how's your summer, which is 2/3 over now?
I know, a couple weeks left. So I had, for this, you don't know, a 10-year-old going into 5th grade, an 8-year-old going into 3rd grade, and a 3-year-old. So a lot of golf. We play a lot of golf, a lot of outdoor basketball, a lot of summer days at the pool with my wife, and heading to Orlando next week to get one last little hurrah before school starts in 3 weeks, I think.
Oh, 3 weeks, unbelievable.
Yeah.
So you're in the summer. You guys are like 7-4 and not even 1.
At 7-4 and 10 months, so we have our hands full.
So this little business trip, is this give you a good night's sleep? How's that work?
Well, I'll tell you what, it's a good night's sleep. My wife just started a new job last week. She had to go to New Jersey, so we're just kind of flip-flopping here. But it's given me a good opportunity to be super dad and today get a break.
And I will tell you, in the Henry house, starting this Thursday, we have a grandchild. My wife will be watching Harper. Congratulations to Alex and Sarah, our first grandchild. I'll probably sneak home early. And we also have a new puppy. Our beloved Maverick died, the golden doodle, after 9 years. So 2 months later, we have now Malachi, who's a Bernedoodle. He's 14 pounds now. He's going to maybe get to be 35 or 40. So we're having fun. So a lot of activity, and a lot of activity this year in the market. So we should start right there. Let's dive in, and let's get onto our agenda here. I should advance mine here. Okay, so let's get to this slide here, mid-year review. There we go. So let's talk about a little background. What's been going on this year? Up and down, a lot of volatility, especially in the month of April. The S&P moved 2 full percentage points 8 times in April. The VIX index, VIX, volatility index, normally it's like 15, 16, 17, jumped to 52. So triple the volatility. Now, guess what? Volatility, no one really likes it. But it goes up as much as it goes down. Let's remember that. And just buckle your seatbelt. You don't have to like volatility. You just have to live with it at certain periods. And typically it works out in our favor over the long run. And we're long-term portfolios, so we shouldn't really be too concerned about the short run. Again, you don't have to like it, just live with it. So that's that. And the last time we had volatility like we've seen this year was when the pandemic started. And also the financial crisis of 2008. So those were a couple milestone points in time. And then, of course, this year. So let's hit the next slide. Greg. Let's go to the, I got to the advanced minors. Okay. New administration, we know that. S&P fell 10.5% in 2 days. It's come back since then. We'll talk about that. So let's dive in and really get into also now global markets in review. And the first slide here, I want to throw this to Chris. International stocks have been dogs for 10 years.
Yep.
Prior to that, they were really good.
Yeah.
10 years, dog. All of a sudden, hero. What's going on?
Yeah, Phil, when you asked me this earlier, I mentioned that eventually every blind squirrel finds an acorn. So maybe it's their time in the sun, right? This definitely talks to why we want to have diversified portfolios. And the last decade's been pretty rough. Our decade to that was excellent. Non-U.S. stocks significantly outperformed U.S. stocks. So could be the start of a new trend. It's just really hard to tell. But if you own international stocks, you're pretty excited in doing so. This year, and it's significantly helped you outperform. The valuations abroad are much more reasonable than the valuations here. And it's kind of hard to separate too because we've become a very global economy, right. But nonetheless, they've had a really good year, and you're very happy for having it in your portfolio. So,
Greg, most of our Symmetry accounts are of the equity portion, about 70-75% U.S. and balance international. And again, that's dragged returns down over the last 10 years because, as we'll see in a minute, U.S. did so well, but not right now. But there's a reason why Symmetry has been putting a 25 to 30% allocation into international, which also includes emerging markets. Can you speak to that?
Absolutely, Phil. Global diversification is so important in your portfolio, and this year, really proves it with the way we started off the year, up almost 18% in international and emerging markets. By only investing in the U.S. stock market, you're really putting your portfolio in risk. I mean, one can argue that the S&P 500 is a well-diversified index, but you are leaving thousands and thousands and thousands of stocks on the sidelines, right? And so not only that, but when you really dig under the hood of the S&P 500 and what's in it, it's really concentrated into 5, 6, 7 securities that are making up, well over a quarter of the index at this point. And so when you have years like this, where technology has not performed well in Q1, had a strong comeback in Q2, but it's a very sensitive sector in technology, in barred growth. And so when you have uncertainty in the markets like we've seen this year, can really impact your portfolio. And so we believe in that global diversification. Currently we see lower valuations in international markets, and that's a big driver of why we've had those returns.
And so we look through June, and global's up almost 18, U.S. stocks up 6 after getting pounded in the first quarter. And even bonds up 4%. 4% is a good year for bonds. We're looking at this as a 6-month return. The real estate's lagging a little bit behind, but it's been a solid performer for a long time, apartment complexes, et cetera. So that's what's happening there. Now, let's get into this. I already alluded to this. A lot of my clients have already seen this. I'm taking credit for this slide. I asked you for this slide, you delivered. A lot of our clients are seeing this. There's 2 slides. We want to take a look at 2 15-year periods. And let's talk, Greg, about this slide, just to tee this up here. The green, it's easy to find the green on here. Green is U.S. growth stocks. Greg, talk about how well they've done from 2010 to 2025.
Yeah, so, I'd say the last decade plus for large growth has really been an anomaly in market. We've seen an average annualized return on these securities of roughly 16%.
For that 15-year period.
For that 15-year period, which is a very, very strong return. Equity markets on average return about 10% annualized over the long term. But you can tell by looking at this that it can also be a wildly volatile asset class. In 2022, it was down 32%.
So let's put that in perspective. If you look at that, can you highlight that? Maybe you can see that. The green bar on 2022 is minus 32. Put this in perspective. You have $1 million portfolio at the beginning of the year. It's worth $680,000 at the end of the year. But if you held for that entire 15-year period, U.S. stocks delivered 16%. But I always like to say that's like the Tom Brady-led Patriots. Super outperformance over a 10, 15-year period, but he's no longer on the Patriots. And things are starting to normalize. Now let's go back also. Let's go back to the 15-year period and prior to that. And let's take a look at this. There's the green again. It starts out strong, 95 through 99. And then, Chris, what happened in 2000? Why did U.S. growth drop to the bottom for 3 years in a row?
I believe it's called the tech bubble, Phil.
Tech bubble burst?
Yeah.
Boom, right?
Yeah, gone.
And these were terrible returns. And then
you had stocks going down 80-ish%. And then, believe it or not, I did see some statements from clients in the last couple of years where they were just starting to break even back from the tech bubble. Because if we talk about the cruel math of losses, if you lose 50%, you need to make 100% return to get your money back.
To get even, right?
So drawdowns are not good.
But then even as it relates, and all these different colors represent different kinds of stocks and bonds. And you can see in 2022, or 2002, the next 4 or 5 years were mediocre. They weren't great years for U.S. growth. And then the bottom fell out in 2008, the financial crisis, 38% decline. Bottom line, if you look at the green bar, 15-year annualized, 6.89% return for U.S. stocks in that 15-year period, followed by 16%. Are we going to see as low as 6% in the next 10 years, 15 years? Maybe not, probably not as high as 16%, maybe somewhere in the middle, like you said, the average of about 10. But we think it's so important to diversify and not just be concentrated in one area is the point of this whole, the power of diversification. So again, if you've seen this chart, I'm living on this chart because I think it's so important to explain why we diversify. Let's get into now the factors. And our Symmetry clients know that you take a kind of a diversified approach, but then you overweight certain factors. And why don't you talk for a minute about, and we'll look at this year-to-date column on this chart. What are the factors that work?
Yeah, absolutely, Bill. For clients, who just need a reminder or aren't familiar with factors, I mean, essentially at a high level, they're characteristics of stocks and bonds that have been identified by academic research to outperform or reduce risk over the long term. So we target value, size, small cap stocks, high quality companies, high momentum companies, and minimum volatility companies. And this year, we've seen value stocks, high momentum stocks, and minimum volatility stocks all outperforming the broader market. Even quality had a pretty good return for the first half, and the only really detractor of performance was small companies, which you would expect in an environment, uncertain environment with the tariffs. It's going to impact smaller companies more than it's going to impact larger companies.
The math on the small companies, Greg, there's close to half the index. The smaller companies are unprofitable, correct? Right.
Yeah.
So that plays a big part of that too. When you have unprofitable companies and kind of an uncertain regulatory environment, that's why they haven't been able to catch much of a bid lately. But there's a lot of value there.
Absolutely.
For sure.
But let me just put some teeth into this. If you look at this top number on the year-to-date, 6.33 is the USA overall return, right? Now look down, you can see the value outperformed that slightly, 645. Small caps, as you just said, was a dog. Quality stocks, not so good. But look at the next ones. Momentum doubled the return. Momentum stocks doubled the return of average stocks. Minimum volatility, diversified multi-factor did well. And then this final one, look at this chart, follow with me. The AWCI All World Index did 10.3, but the factor model did more than that, did 11.5. So if you're a factor investor and you're deploying these various factors, except for a couple instances, you outperform the broad market, which is why you're seeing some really good returns over the past, certainly 2024 was a good year to date, 25. We're happy to show you this, but we're just repeating the same story of diversification and then taking advantage of some factor investing, which is what Symmetry does a great job of. So let's get into that. We talked about this, and we're sailing here. We're not trying to keep these people. They have things to do. Let's talk about the big, beautiful Bill Act, okay, that was signed. Let's go back to what slide are we on here? Okay. July 4th, 2025, President Trump signs this bill. We all know that kept the tax rates intact.
Correct.
Instead of sunsetting to go back to where they used to be, which would have been a big increase.
Correct.
We kept them where they were. I think that works out well for most people.
Almost certainly. I mean, the brackets were going to increase on average by about 3%.
For each bracket.
Correct.
So that's a huge number.
Can be quite significant.
So that we have certainty now on tax planning, which we're happy about that. So that's number one. Let's go into the next and dive into some of it. You're meeting with clients all the time.
Yeah.
What are you telling them about standard deductions, about car loan interest, and about Trump accounts? So talk about these three.
Yeah, so standard deductions increased. So 15,000 for single, 30,000 for joint. Plus there was also a one-time increase for 2025. So I think there's gonna be some pleasantly surprised people.
But wasn't it 12 and 24 before, now it's up to 15 and 30?
Yeah.
Okay, so nice increase
Nice
there.
bump. There's also a unique element in there for seniors. So I did a mock return for a client the other day and saw a pretty significant reduction in his taxable income. So there's seniors that are single are getting a $6,000 reduction on top of the standard deduction, while married filing jointly are getting a $12,000 joint deduction. So there are some phase outs, but these extra deductions for seniors do hold through 2028. So I think you're going to be pleasantly surprised and have some opportunities for some fun planning there. Auto loan interest, another one. Not getting political, but Trump's, they're obviously very pro-America, wants to tout American-made stuff. So any vehicles assembled here in the United States that hit certain criteria, and loans that were taken out in 2025 or refinanced in 2025 without taking on additional debt, you can qualify to $10,000 reduction in interest. So, they're really trying to keep that auto market intact and moving.
And the phase out is for $200,000 for joint returns and
Correct.
lower.
Yeah.
So a lot of people are going to qualify for this.
Yeah, there's a lot that happened in this one big, beautiful bill, the OBBBA, as they call it. And a lot of it has phase outs in there. So it's really important to understand where your income's coming from and what you're looking like for the year, and have that coordinated conversation between Phil and your CPA to make sure that you don't trick yourself into falling into the phase out and not meaning to do so. From taxability to investment accounts and retirement accounts and income at work, and should be doing pre-tax, should be doing conversions. I can talk about this for days. There's a lot of phase outs, but a lot of really, really good stuff if you understand where your income's coming from and you're planning for it. One of the more unique elements were the Trump accounts. I think it raises a bit more questions than answers at this moment.
Yeah.
It's a whole different account. It's not a retirement account, but it acts like a retirement account. It kind of looks and feels like a 529. So either they're going to pilot the program and start with $1,000 for kids born now and on. Kids that are under 18 can open the accounts. Don't ask us yet because I'm not exactly sure how we're going to do that, and if they're actually called Trump accounts, if there's some other unique element for them. But nonetheless, like I have kids, as I mentioned, as this Fred, and my kids don't tell the IRS this are on my payroll, and they do have Roth IRAs, so I'm very into planning for my kids.
And I have a grandchild.
Correct. That's
Did
right.
I mention that?
Yes, that's right. So, it doesn't, the kid, if they have earned income, can contribute to a retirement account, right? So if your child has a job, whether it's a Chick-fil-A or whatever, you can contribute to a Roth IRA account with that earned income. The Trump accounts do not require earned income, so you can contribute to them. Charities can contribute to them, and they don't count towards the $5,000. Your employer can contribute. It does count towards that $5,000 annual limit. So there's a lot of interesting things out there. You can't get overly complex with the investments, but you can invest in the S&P 500. It's super interesting, super intriguing. As a father to 3 children, I'm definitely going to look at it pretty hard and see if I can use it and combine it along with what we're already doing with the 529s, my kids' Roth IRAs. So CBD.
Stay tuned.
And I will say, though, this just kind of going off on a small light tangent here. A well-respected individual that I read a lot of his information said this could be the very first step in almost kind of going towards a privatization of Social Security. So if you can start offloading savings to children at this point and get them well-funded with money they can't touch until 59 and a half, you could see if this is adopted well and has a high success rate. This might be kind of that gap fill to Social Security problem we're going to be staring at here in a couple of years.
And I will say this about Social Security. I heard an interesting stat that if the trust fund blows up, and it could blow up in 10 years unless there's a change made,
yeah, it's like
80% of benefits that are paid now come from payroll taxes.
Correct.
So if the trust fund blows up, then you would say that the benefits you receive now would drop 20%. Now, no one wants them to drop any percent.
Yeah.
But if the trust fund goes away, that doesn't mean the benefits go away.
No.
They would drop by about 20%. But let's try to fix this in the meantime.
Yeah, they keep raising the income limit, right? Like, just a couple of years ago, if you made over 115,000, you didn't pay the payroll taxes on the amount above that. Now it's up to like 180 or 190,000. So they keep increasing those limits. They got rid of some aggressive claiming strategies. There's a lot of things that they're doing, but Phil's exactly spot on. If it does run out of money, the money that's collected today is enough to continue paying 8% of the benefits. Right. So we'll see. It's something the politician probably wants to touch. But I truly believe that folks that are approaching or in retirement are not going to have any issues. Yeah.
It's the younger, the 20s and 30s.
They're going to do that. They might throw a means test on there. That's my opinion. I think if you're making too much money, they'll have reasonable justification to say you're going to lose your benefit. But I think that'd be a really high income level, like over $1 million a year income, something like that. But aside from that, I feel pretty comfortable with what's there and the information that we have today to continue making the decisions that we're making.
And let's kind of go over this final slide here. Let's get onto this.
Yeah.
A few more of the big, beautiful bill, child credit, permanent tax. We'll talk about these.
Increased credit. Credits are great. Credits go against taxes owed. Big difference in credits versus deductions. Deductions take away income. Credits go against taxes owed, so credits are great. Give me all the credits you can. Permanent tax cuts, SALT cap. That's a big one. Not so much for Pennsylvania.
Explain to people what a SALT means.
Yeah, so SALT, it's not what you put on your food, but it's state and local taxes, right? So previously there was a level put on it that you could not itemize more than $10,000 of state and local taxes. And that includes all these, real estate taxes that you're paying. So for folks in higher tax states like New York, Maryland, whatever, that have really high tax rates, property tax rates on these larger houses or wherever they may live, that $10,000 cap didn't go very far, and it made it hard for them to itemize. Now that cap is up to $40,000, and that carries through 2029. There is a phase out, so you do have to be careful of that. But that opens up that opportunity there, and who knows, maybe that continues the real estate boom that we've seen, and it makes people a little bit more comfortable carrying that.
And let me throw, I forgot to mention.
Yeah.
Do you have a question? It's your question box. Do we have any questions popping in here? Maybe we do. Let's see. We'll track this. Okay, so hey, I know no one wants to ask the first question, so skip that. Who wants to ask the second question? But we still have two more. Roth conversions. You're a big Roth guy. You're a Roth conversion guy. Talk about Roth conversions and how the tax rates help.
Yeah, tax rates give us an extra window, right? Because we were planning on tax rates going up at the end of this year. I'm a big fan of paying taxes once and never again, and that's what the Roth does. So it pays. I can't tell you enough how important it is to understand where your income's coming from and what you're doing and just paying attention. Small conversions, big conversions, all really, really important. If you're still working, should you be contributing to Roth or pre-tax? Very important things to consider. But now that we have a little bit more idea of what's going to happen, things are locked in, rates are fixed for a while, increased deductions. I think it just continues to increase the opportunity to consider conversions.
And I think my clients will know this. I all the time ask you who your CPA is. Let's talk. What's their opinion? Let's collaborate on this.
Yep.
Because at the end of the day, the accountant has to sign off on this as well. But this is a big point. These conversations aren't going to go away.
No.
But if the rates, tax rates are going to go up, we were going to be sprinting.
Correct.
Towards Roth conversions. Now we can just keep a nice even pace
and
continue having these conversations about Roth. So, and then there's some estate advantages. I mean, it's not going to impact a lot of people, but some people.
Yeah, I mean, they made the estate tax exemption $15 million per person. So
instead of 13.2.
Yeah. Okay. So if you got over 30 million, congratulations. The federal government's not going to tax you on that at your passing. If it's under 30 million. If you're over 30 million, then we got to talk. There's some fun.
And that's federal estate taxes. In Pennsylvania, there's still 4.5% state.
Yeah, there's multiple levels here, but that's just federal, right? So federal estate tax applies to anyone that has assets north of 30 million. In the state of Pennsylvania, there is a PA inheritance tax rate, and that rate depends on who it's going to. It's 4.5% to lineal descendants, 12.5% to relatives, and 15% to non-relatives, and that's on the first dollar. So if you have any assets and you pass in Pennsylvania, they're very retirement friendly, as they don't tax IRAs, but they will tax your assets unless you gift them and you live past a year. So pay attention. We do a lot of shifting of assets with attorney blessings and gifting just to avoid that PA inheritance tax, because 4.5% is real money. It's not 40% the federal government will tax you, but 4.5% is good. Yeah, it's money.
So hey, we always like to be under 30 minutes. So we're cruising here. Let's summarize. Okay, so far we've talked about how important diversification is. We said how internationals will really pop back up. Valuations are low. It's only a matter of time until it comes back up. It came back up. I'm looking at you. All of our clients, we didn't want anybody to eliminate international from their portfolio, and that's really paying off now. So we're happy about that. U.S. growth was terrible Q1, pretty strong in Q2. Let's just stay diversified. We like being, we love stocks. We just want to be diversified, not too concentrated in any one area. And bonds are doing well also. So that's that. Volatility, volatility comes and goes. There could be more volatility this year. There's some more tariff things, some more fights in the House and Senate about some extra tax cuts, et cetera, some spending reductions. So there will be some more, could be room for more volatility.
There's gonna be no shortage of headlines.
Yeah. Buckle your
There's always
seatbelt.
some headlines.
Buckle, we're in a long-term plan, short-term volatility, buckle up, okay? When it comes. So that's that. And I think that's really all. Greg, what do you want to tell us about?
We have one question.
Oh, we did. Well,
Yeah.
who is it?
So let's throw it over to you guys. If you're close to retirement, does it make sense to put new money into a Roth 401k versus regular pre-tax 401k?
I have an answer. My answer is if you're in a super high tax bracket, you're making a lot of money, maybe just continue on your strategy. But if you're 22% or lower tax bracket, yes, let's feed the Roth. What are your thoughts, Chris?
Very personalized decision. A lot of times we'll have folks doing Roths, and in the last couple of years leading up, they'll do some pre-tax. But to me, very unique to each individual, depends on your makeup of assets. If you only have pre-tax assets and not a healthy cash savings and no Roth dollars, yes, it can make some sense. But we do find that most folks, as they get really close to retirement, they're probably going to look at a reduction of income. So we do want them possibly taking deductions on the last couple of years. But it's a very personalized answer. There's no rule of thumb. It really has to determine what your plan is and what your dollars are. But that's the right question to be asking and something you and your planners should be looking at.
And I can tell you that for our kids, and your kids are young professionals that are just getting started out, we're just go with Roth. Just act like there's nothing else.
Oh, yeah.
Just get used to making after-tax investments that will never be taxed again.
Right. But as you get closer to retirement, you very much need to look at what your tax rate is today, what your projected tax rate is going to be in retirement, and what kind of assets you have, whether they're pre-tax, post-tax, or non-taxed. And that would kind of help you answer that question. It's very unique, but when you're young, hammer it, all Roth.
Right. So, hey, let's conclude this. We appreciate you very much. Some of your clients are on this call, my clients. My clients are very familiar with Greg. We appreciate you and flying down from Glastonbury to be here today. All right. So thank you very much. Hey, email us with questions, comments. We hope you enjoy these little webinars. And thank you for your business and your trust. Have a great day. Thank you very much.